In a world where economic uncertainties cast a shadow over financial stability, the quest for strategies that can withstand the relentless force of inflation becomes a priority. The soaring prices of daily necessities, coupled with the unpredictable fluctuation of currency values, create an environment that demands careful consideration of investment choices. As Warren Buffett's wisdom suggests, the massive economic interventions witnessed today are likely to trigger inflationary repercussions, underlying the urgency for investors to be well prepared. Let us look at the advice Warren Buffett has given. To navigate this landscape, Buffett's advice includes leveraging essential tools such as bonds, dividend-paying stocks, and diversification. However, before delving into these strategies, gaining a firm grasp of the fundamental concept of inflation is paramount. Inflation, in its simplest form, is a gradual erosion of the purchasing power of money. Imagine the surprise of reaching your favourite lemonade stand with a crisp $10 bill in hand, only to find out that the cost of your favourite refreshment has unexpectedly increased. Yet, this phenomenon is not confined to a single lemonade stand. It ripples through the economic worldwide, eroding the value of money over time. In the realm of investments, it's important to recognize that success doesn't solely hinge on data and statistics. Buffett's emphasis on the impact of the right investment decision resonates powerfully. Sometimes in the intricate dance of economic dynamics, making the right investment choice can lead to financial prosperity. At the heart of the matter lies the root cause of inflation, an increase in the money supply. This supply is available money, can drive up the prices of goods and services, creating a domino effect that touches various sectors of the economy. Additionally, factors like heightened demand and unforeseen global events such as geopolitical tensions can further amplify the flames of inflation. Buffett's metaphor comparing interest rates to gravity underscores their pivotal role in the financial landscape. Interest rates exert a gravitational pull, shaping the trajectory of investments and financial decisions. Beyond just influencing price tags, inflation impact resonates within businesses, potentially altering their performance and financial outcomes. This crucial intersection between inflation and investments becomes a matter of profound significance, especially during periods of economic ambiguity. In the realm of economic consequences, as eloquently described by Buffett, inflation yields a formidable impact. Its insidious impacts confronting the devaluation of hard-earned savings and its tumultuous upheaval of the business landscape. This stark reality prompts a pivotal question. How can individuals navigate the treacherous waters of heightened inflation? Here, the vital lesson is that the conventional avenues of investment, which may have proven effective during stable economic periods, might falter in the face of soaring prices. Thus, the call for adaptation becomes an urgent imperative. Addressing inflation's challenges demands more than a cursory response. It necessitates a comprehensive strategy that encompasses proactive adjustments and a willingness to explore alternative investment approaches. Engaging with inflation is akin to embarking on an intricate journey where one must unravel the complexities of new investment paradigms to flourish and prosper amidst escalating costs. This is the essence of positioning oneself for optimal investment decisions with an inflationary context. Warren Buffett's investment doctrine is intrinsically synonymous with the concept of long-term value. His resolute belief posts that the allure of swift and effortless gains often proves illusory, particularly in the tumultuous throes of inflation. As he eloquently articulates, achieving satisfactory investment returns does not necessitate an expert-level understanding. Instead, it mandates acknowledging one's own limitations and adhering to tried-and-true methodologies. The credo of simplicity resonates profoundly. Buffett urges against chasing mirages of extravagant returns that promise instantaneous wealth. His counsel to resolutely decline such alluring prospects is a testament to the notion that enduring success springs from consistency and strategic alignment rather than fleeting spikes in wealth. Central to Buffett's enduring investment success is his unwavering commitment to discipline and instinct. He steadfastly champions a long-term perspective, a choice rooted in prioritizing overarching goals over the transient fluctuations of the market. His investment acumen thrives because he remains steadfast and unswayed by the allure of short-term market gyrations. Buffett's legacy radiates as a guiding beacon amidst the labyrinth complexities of economic uncertainty. The journey to profitable investments in the midst of inflation necessitates a twofold approach: an adept adaptation to evolving circumstances, coupled with an unwavering commitment to disciplined, long-term strategies. Buffett's legacy underscores that success emanates from acknowledging one's limitations, charting a course aligned with one's overarching strategy, and nurturing the patience to allow investments to mature and flourish over time. Buffett's evocative comparison of inflation to a relentless corporate tapeworm offers a vivid insight into corrosive nature. This metaphor underscores the tapeworm's unyielding consumption of investment funds, irrespective of a company's financial health. This relentless feeding necessitates increased expenditure on receivables, inventory, and fixed assets simply to maintain the same operational levels. In this context, the power of pricing strategies comes to the fore. Buffett's recommendation to invest in companies with the ability to adjust prices to protect profits amidst economic erosion is a testament to the importance of this factor. Buffett's investment philosophy serves as an indispensable guide through the labyrinth terrain of inflation-induced economic turmoil. Rooted in dividends, tangible assets, and strategic pricing, his approach offers a beacon of stability. This resilience enables investors to weather the storm of inflation, emerging from the tempest with financial integrity intact. By adhering to these principles, one can navigate the intricate complexities of economic uncertainty, drawing inspiration from Buffett's astute strategies for wealth preservation and growth. In the realm of investments designed to combat the erosive impact of inflation, the concept of inflation index bonds emerges as a notable strategy. An exemplifier is Treasury inflation-protected securities, which possesses the unique ability to adapt its principal value in sync with fluctuations in the consumer price index. The brilliance of this approach lies in its capacity to escalate the principal value of these bonds in tandem with the rise of inflation. This, in turn, corresponds to an augmentation in interest payments. The central tenet here is to ensure that investors receive returns that are harmoniously adjusted to the rhythm of inflation, thereby providing a safeguard against the corrosive nature of declining purchasing power. The notion of inflation protection securities constitutes a strategic line of defense against the adverse effects of inflation. This category encompasses a spectrum of options, spanning from tangible assets like gold to dynamic real estate investment trusts and specialized exchange-traded funds, targeting assets sensitive to inflation. Gold, often perceived as a haven during inflationary surges, is renowned for its propensity to appreciate in value when traditional flat currencies falter. Warren Buffett's axiom of diversification resonates powerfully in the context of crafting portfolios resilient to inflation's bite. His assertion underscores diversification as a potent strategy to counteract the ignorance of unforeseen events. This principle holds particular weight in the landscape of investments, especially when navigating the uncharted waters of inflationary periods. By interweaving dividend-paying stocks, bonds, and inflation protection securities into a well-crafted portfolio, investors can effectively disseminate risk and potentially reap enhanced returns even amidst inflationary ebbs. Buffett's encapsulation of not placing all eggs in a solitary basket translates vividly into the investment realm, particularly in the face of imminent inflation. The practice of diversification guarantees the judicious allocation of resources, fortifying vulnerabilities. This strategic approach resembles an arsenal of specialized assets, each endowed with its unique strengths and roles, collectively bolstering the portfolio against the turbulence of market fluctuations. Preparation for the onslaught of inflation demands a profound understanding of the concept of pricing power wielded by business. This power hinges on the capacity of companies to recalibrate prices in response to burgeoning costs while maintaining profitability. Amidst inflationary surges, consumer purchasing power often dwindles, owing to escalating prices. However, businesses endowed with robust pricing power can navigate this terrain adeptly, transmitting the burden of increased costs to consumers without triggering a significant dip in demand. The relevance of pricing power finds a strong foothold in companies boasting formidable brands and steadfast customer loyalty. Such enterprises can command high prices, even in the face of cost escalations, attributed to consumers' willingness to pay a premium for established products or services. Likewise, industries characterized by limited competition or high entry barriers empower businesses to uphold pricing power, as alternatives available to consumers are scarce. In contrast, businesses lacking pricing power might grapple when inflation strikes, struggling to raise prices without alienating customers in fiercely competitive markets. When constructing portfolios geared towards withstanding the erosive impact of inflation, investors must meticulously assess a company's capacity for pricing power. Elements such as brand robustness, industry dynamics, competitive landscape, and consumer behavior all play pivotal roles in this evaluation. Firms equipped to revise prices upwards without compromising profitability are better positioned to outperform peers in the landscape of inflationary pressures. In a world of economic uncertainties and the relentless challenge of inflation, Warren Buffett's investment philosophy emerges as a guiding light, offering invaluable insights into navigating the tumultuous landscape. Through the prism of his wisdom, we uncover the power of dividend-paying stocks, inflation index bonds, and strategic pricing power, all crucial elements in constructing a portfolio that stands resilient in the face of inflation's erosive forces. Buffett's time-tested principles remind us that amidst shifting tides, a disciplined, long-term approach combined with astute diversification can shield our investments and pave the way for financial stability and growth. As we journey through the realm of investing during inflation, let us heed the wisdom of the Oracle of Omaha and chart our path with prudence and conviction. Enjoy the insights shared in this video. Don't forget to show your appreciation by liking this video and hitting the subscribe button for more illuminating discussions on investment strategies and financial wisdom. Join our growing community of informed investors and don't hesitate to share your thoughts in the comments below. Your engagement fuels the dialogue and enriches our collective understanding. Until next time, remember to stay informed and empowered in your pursuit of financial prosperity.